class. So now we're moving on to phase 4, chapter 3, and this is phase 4-4, issue the audit report. So we're finally in this reporting results, and so you must, whether statements were prepared in accordance with GAAP, so that's the criteria that we're using GAAP. Circumstances where GAAP is not consistently followed, that's just an implied statement, so you don't actually see that explicitly stated in the final report, but it's just implied. If there were any deviances from GAAP, then it could be stated. Adequacy of information, informative disclosures implied, so again, that's not stated unless they don't have that, and then express an opinion that has to be explicitly stated. And then these slides will give you what is part of an unqualified audit report, but your final quiz is open book, open note, so I don't know if you have to study these as in depth because you can refer to them or these slides. We have to include independent in the title. The audit report must be addressed to the CEO. No, it can be addressed to the shareholders or the board of directors. And these are the explicitly versus the implicitly, so that was in the first slide. So conditions for a standard unqualified audit report, all financial statements were audited and included. Sufficient evidence had been accumulated, so we didn't have any limitations of scope there. Financial statements are presented in accordance with generally accepted accounting principles, and there's no circumstances requiring an explanatory paragraph or modification of wording of the report. So there are certain circumstances where we have to modify the report, and so those will include an explanatory paragraph added to our audit report. And so those are just notifying the investor that there's something of concern, and so we as auditors need to let the investor know. So there's 4 main categories, and then you should know all of these. So this is their clean audit opinion. That's our best unqualified. Hopefully you have that pretty clear from the full semester. An unqualified with explanatory paragraph or modified wording, so that one we'll talk about. There's specific conditions. Qualified and adverse, which is bad, and disclaimer, which is kind of like no opinion. You don't get enough information. There's been a huge, highly material limitation of your scope, and so that's when you just can't express an opinion. So pretty much no opinion, and that's bad because our job as auditors is to express an opinion, but the client has limited our scope. So pervasiveness and spread throughout, depending on how material your, right? So a material weakness said it was highly likely and it was material, right? And so not only is it highly likely a material for a material weakness for controls, now we're looking at how misstated, right? The likelihood of misstatements, and are misstatements pervasive? Did you find pervasive misstatements that are spread throughout all of the financial statements? So are they spread throughout the financial statements? And if they're highly material, they hit every single account. Specifically with this inventory, if they're going to hit every single account, that would be highly material to the audit, and then that could give you an adverse, or make the auditor have express an adverse opinion. What are the 5 circumstances when unqualified? So these are 5 circumstances, and the acronym is GECDO instead of GECO, GECDO. So going concern, if we're worried about them continuing within the next year, we would express that an unqualified with an explanatory paragraph or modified wording. So I have been on an audit where we had to express an unqualified with a going concern paragraph. So that's where we did our unqualified with explanatory paragraph or modified wording. Emphasis of a matter, so related party transactions, subsequent events, material uncertainties. The auditor's just bringing that to the attention of the investors or the shareholders. Consistency, when they depart from GAAP or lack of consistency, application of GAAP, and then departure from GAAP. Auditor agrees with departure from GAAP due to belief that compliance with GAAP would be misleading. So say they use cash accounting and accrual GAAP accounting. GAAP says we should be using accrual accounting. If the auditor believes that it's more transparent to use cash accounting for this specific business, say it's agriculture or mining or things like that, if they have their own specific way of doing it, it might be a better or more transparent audit if they use that, and so the auditor departs from GAAP and agrees with the company that they're auditing departs from GAAP and the auditor agrees with that departure, or other auditors. So there's specific auditors, we can't audit the whole company, and so a subsidiary could be audited by a specific auditor, but we won't get too into the details of that one. What would cause you to have a substantial doubt about the company's ability to successfully operate for at least another year? So that was in the previous video. They have coronavirus that shuts down their whole operations, or they have customers that fail, or their product becomes illegal from the government issues. And so under certain circumstances, CPA might want to emphasize specific matters. Consistent application, so there's change in accounting principles, so change in depreciation, change in inventory cost flows, and then departure from a promulgated principle. This auditor must satisfy and must state and explain in a separate paragraph, so that's the departure. And then you could make no reference to the other auditors in the audit report, or make a reference or qualify the opinion, depending on if you want to rely on the auditors. What types of audit reports that can be issued when an unqualified opinion is not justified. So we say it's unqualified or unqualified with the explanatory paragraph, but if you don't believe that that's adequate, then we could use, there could be a scope limitation, a GAAP departure, or the auditor's not independent. So qualified opinion can result from a limitation of scope or failure to follow generally accepted accounting principles. So if you couldn't confirm a specific thing, or if you have materiality, so remember you set your materiality and the client has greater misstatements than your materiality, and the client refuses to adjust those misstatements, then you would give them a qualified opinion. So pervasive, so materially misstated that it would be misleading, that they do not present fairly the financial positions. So this is our bad opinion because they have pervasive misstatements. You can never give an adverse opinion if you simply lack evidence. An adverse opinion means that the financials don't comply with GAAP in a material way. And then disclaimer, the auditor lacks independence or given if the scope limitation is pervasive. So a very highly material scope limitation. So I'm going to go to your, I'll go to your questions for Engage 15, and I'll do that in the next video.